Well, a warm welcome everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial. Today we have Paul Sleiman, who's the Distribution and Sales Director from Vinva Investment Management. Paul joined Vinva in July 2024, and he's responsible for implementing the strategy to grow the business, focused primarily in the wholesale market. Prior to joining Vinva, Paul was a key account manager at First Sentinel from 2019 to 2024. At First Sentinel, Paul was responsible for redefining the New South Wales wholesale distribution strategy for identifying business opportunities in the private wealth segment and independent asset consultants. Also, previously, Paul's had various distribution roles at SG Hiscott and Company, Perennial Investment Partners, and the Commonwealth Bank. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation, or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Please also refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Thanks for joining us today, Paul. It's been about 12 months since we last spoke, and a lot's happened across the global equity markets, including ongoing inflation concerns, changing interest rate expectations, development in AI, and increasing geopolitical uncertainty. Can you give our viewers an update of Vinva and the Global Alpha Extension Fund?
Yeah, absolutely. Thank you, Joel. Thank you for having us on, and thank you and your clients for their ongoing support of the Vinva capabilities. It's been a positive year as it relates to the Vinva capability more broadly, which has been pleasing to deliver a good level of outperformance for our clients. Over the last 12 months, the Vinva global equity capabilities delivered 17% net of fees return. That's an outperformance of the global equity index of 15%, which is sort of delivered 2% over the market. In a period where it's been really volatile as it relates to sort of geopolitical news and geopolitical influence within the market.
Yeah, right.
I think what might be interesting for your clients, Joel, is we've actually built a presentation that sort of covers in terms of Vinva's sort of key edge, how we're sort of seeing markets, and maybe sort of a little bit of a deeper dive in terms of our process a little bit further, if you don't mind me sharing.
Oh, perfect. Let's do it.
Just want to confirm you can see my screen here.
Yeah, I can see it.
Yeah, brilliant. Well, some of these points as it relates to Vinva's key edge here, sorry. We're a growing organisation. I know it's sort of 47 billion as it sort of sits here today, but as we sit here today, our total funds under management is actually 62 billion. So sort of grown substantially since this presentation's been put together. We manage money on behalf of all the large super funds, all retail clients, a real breadth of client base, and it's a privilege to be entrusted with such large capital on behalf of our clients. But really, the genesis of what we do is very much focused on delivering that alpha, the relentless pursuit of alpha, and focus on identifying opportunities across 48 countries, 15,000 stocks. If I just dive a little bit deeper in terms of the changing landscape, often we talk about data and the explosion of data, and here you can sort of see the changing landscape as it relates to both structured and unstructured data, but data more broadly. And what you'll see here is a real explosion from 2000 to 2015 in terms of that data landscape. But if we fast forward to today, you can sort of see that sort of 75% of the world's data has been created in the last 3 years alone. That exponential growth has been quite substantial. 80% of that data is actually unstructured. It could be videos, texts, photos, and the likes. And
I don't think I've ever seen the term zettabytes before, so that's quite amazing.
It's incredible, and you can sort of see that little ticker of data that's been created since this last sort of press, and it is that explosion's been huge, and that has wide implications across many industries, but also notwithstanding funds management. And what we've seen there, Joel, is the fact that implications for funds management is scarce. That information scarcity is no longer there. The data has now commoditized that access to information. Stock pickings becomes harder because the global economy becomes more interconnected. We're strong advocates that more data doesn't necessarily mean to better information. So it's how you filter through data to identify what the insight is, what level of information you're looking to extract, and how you do that on scale. That is how you build a sustainable edge, and that's very much how we're focused at Vinva in terms of building that edge for our clients. I sort of mentioned earlier, it's 48 countries, 15,000 stocks that we cover, and this is where a systematic process really comes into its own. If we're an active manager and we've got views on what drives future stock returns, if we're looking to apply those views individually on our own, the best we can do is maybe cover 1 to 200 stocks. What we do at Vinva is actually apply those views systematically through data and technology, and apply that without any bias and without any fatigue. And what that allows us to do is have broader insights across a broader universe, and importantly, actually deliver broader, more diversified portfolios for our clients. So what does 15,000 stocks actually look like? These tiny sort of little stars in the sky, as I call them, I can hover across any of these 15,000 stocks, and I can explicitly show you Vinva's view on any given stock, what our active weight is within that stock, that is our position above or below the index, and what's driving that position. And Joel, often we get told that, you know, systematic equities, systematic investing is a bit of a black box. It's a lot of data in, it's data out. We believe we're a little bit different. We believe that we're more insight driven, and that we can sort of rationally explain to any of our investors what drives our process, what drives our returns, and importantly, where they're exposed in the market cycle. Not too different to any sort of active manager in the market. And here's a little example of modeling the global ecosystem and what a systematic manager allows you to do on scale. Now, often when you speak to any equity manager, when you're looking at a company, they'll sort of assess the customer universe, the supplier universe, they'll model what the competitors are doing. And that is all very, very important as it relates to understanding a company's journey and where its earnings are going. Often what is left, or often what is missed, is the fact that sort of the ability to do that on scale en masse. And, you know, what we've been able to do is across those 15,000 companies is identify 12 million linkages where various companies, through suppliers, customers, non-obvious linkages, influence a company's share price. So if I just click on McDonald's as an example, you know, a very simple example for our clients, you can sort of see the broader universe that sort of influences McDonald's earnings day to day. We know net, if McDonald's has had a great year, they're going to demand more from their suppliers. You know, we know that their customer universe is going to benefit from that as well. So you can sort of see how that sort of flow of information across companies allows us to build that edge, importantly on scale, but importantly, you know, very efficiently as well. When McDonald's comes out with a set of earnings, we're able to identify the upstream and downstream effects of an upgrade or downgrade, what it means for the broader universe. And that is the power of systematic process. Again, taking a very fundamental insight, but applying it through data and technology to give us a more broad insight. And that's effectively one part of the investment process that we're able to identify strong ideas that are going to generate consistent outperformance for our client base.
And with this sort of technology that you use for modeling, is that updated in real time, live time?
Yeah, absolutely. You know, our database runs 24/7. We've got about 5,000 data jobs every day that sort of go into our database, and that's sort of part of our process internally in terms of focus on continuous evolution, and that's sort of including the way in which we view stocks. You know, what are the insights that drive stock returns, but also our database, continuously investing back into our database, making sure our database is scalable, can process a lot of data and do that very efficiently. So the continuous evolution is in our mantra, and it's sort of part of the ethos at Vinva. Yeah, if I just sort of move on in terms of, you know, we take really sort of fundamental and non-fundamental ideas. We look at, you know, valuation of a company relative to its peers. We look at quality of management, quality of balance sheet. Again, not too dissimilar that to what your clients might be used to hearing from an active fundamental manager. And then we take non-fundamental ideas. I mentioned that sort of interconnectedness of the broader universe earlier. We machine read over 200,000 broker reports every year. We use language learning models across 3 million news articles every year, all to build impulses around what is the view on a particular stock, what's going to drive it over the long term, medium term, and short term, to ensure that we position our portfolios appropriately. And we're doing this around the clock, as I sort of mentioned earlier, and as depicted by this graphic.
And are the strategies long only, or do you also take short positions?
Yeah, it's a great question. In this particular strategy, we deliver what we call an alpha extension portfolio. And at the genesis of the Vinva process, or portfolio that we like to deliver for our clients, we want to be neutral on key thematic risks, key style risks. So you don't hear us talking about things like, you know, being a value manager or a growth manager. We don't like taking big positions in countries or sectors relative to the index. So what we want to be is really tight on those big thematic plays, and deliver as bottom-up stock selection process as we can. The maths are stark. When you look at the index makeup, the Mag 7, the top 7 stocks make up 20% of the index. The top 100 stocks make up 70% of the index. Any stock outside of the top 100, the average index weight is about 4 basis points, 0.04%. So what we've often found is our insights are very good at picking up ideas that deliver outperformance as well as stocks that we believe are going to underperform. And often what you have in a long-only portfolio is the fact that if you've got a stock that you believe is going to underperform, the best you can do is not hold it. And in an investable universe where there's 20,000 stocks, Joel, we're holding 500 positions. We like diversification. So what we do in this particular portfolio is we do short stocks that are very small index weightings. So if we have a view that Nvidia is going to underperform the index, and Nvidia is 8% of the index, typically we'll hold about 7%. So a 1% underweight versus the market. If we have a view that a smaller stock, if we just take, let's hover around one small stocky, Dexcom, which is a healthcare stock. If we had a view that Dexcom is going to underperform the broader index, and it was, let's say, 4 basis points of the index, then we will short Dexcom by 96 basis points, 0.96%. That is the same active position as being underweight Nvidia through a 7% holding as Dexcom. It's a function of the index weight.
Yeah.
And ultimately what we're doing is delivering a market-like return composition. So we take 30% shorts and then we'll go long 130% and delivering what we call a beta 1 portfolio for your clients, which is tightly managed on risk, country, sector, style, and deliver what we aiming to do is deliver that consistent return stream above the market. Whilst importantly, and this is the key point for your investors, Joel, is capturing the market return. The beta 1 profile that we talk about is that we are correlated to the broader economy and the broader market. If the market goes up 10%, this portfolio is designed to deliver somewhere in a bad year, it's going to deliver 8%. In a good year, it's designed to deliver 13%. Conversely, if the market falls 10%, it's designed in a good year to deliver negative 8%, in a bad year, negative 13%. It is range bound by the market. And often what we find is there's a lot of good managers out there, but because they constrain their portfolios in certain countries and sectors, sometimes the market can go up 10% and then they might be down 2% because they've taken inverted bets against the market. That's not our approach. Our approach is that we're in the long-term belief of the reason you invest in the market is you believe that over the long term, the market's going to deliver, historically, it's delivered somewhere in the range of 12 to 15% per annum. Long-term over a 100-year cycle. So what we want to do is make sure we capture that return stream of the market with a little bit over the market whilst being risk controlled.
And Paul, with this being systematic, does that mean that the system that you guys will automatically start taking positions and reducing positions and there's no human interaction at all?
That's a great question, Joel. And often, the question I get is, what is our greatest asset? Is it the system? Is it our people? Is it a mixture of both? And ultimately, the system starts and ends with the people. And our greatest asset as of an organisation is our people. It's our people that come up with the insights that we believe. It's our people that come up with the ideas that drive future stock returns. And those ideas, we believe, are the most efficient ideas about identifying whether a stock's going to deliver outperformance or underperformance. Often where human anatomy allows or disappoints is often in execution. And that's because our biases come into the process. So often, I know bad analogy, but through footy tipping, long-suffering St. George fan, and the number of times I've sort of felt like they're going to win this week and haven't have sort of, that's my own sort of emotional biases coming into the process. And that's the sort of biases that we're looking to extract out of the decision-making process. So where people sort of come into the process is coming up with the ideas, and then we use data and technology to implement those ideas. Once we've come up with the optimal portfolio, our people don't sit there and sort of start to override the data or the database. What they're there to do is hygiene check that everything makes sense. Everything is logical. The right information's been fed through. We don't sort of sit there with the noble at the end saying, oh, really don't like Nvidia at these sort of multiples. Let's not put that trade on because we believe that's our biases. And often we've found that our most uncomfortable trades are often the most profitable trades for our clients. So what we do is our people implement the process. And if we believe something's not right, we always go back and say, what is driving this decision? Can we improve this? Does this need to be looked at further? Or we just put our hand up and say that is our own bias coming to the process. We need to just follow the process. So we don't at any stage override the model unless we identify some issues come through.
Okay.
And if I just sort of touch on performance, I sort of mentioned it's been a really strong year. Sorry, just going back to the portfolio. What we're looking to deliver is consistent return stream for your clients. What we don't do is bet the house on a particular stock or particular industry or particular country. So if you actually have a look at the number of overweights, underweights, the number of bubbles and the size of bubbles, it's really demonstrative of what we like, which is breadth. and that diversification effect for your clients. So I sort of mentioned earlier that we don't take big bets on countries or sectors or stocks. And this is a really good infographic just for your clients to understand that we sort of take a wide variety of active decisions across underweight decisions and overweight positions. Our underweight positions, I mentioned earlier about the extension nature of the portfolio. Some of these might be expressed in a short, some of these might be expressed just through a long only holding. It is a function of how much of the index that company makes. And conversely, on the overweights, again, that's full transparency approach around what's driving our overweights and our underweights. Sometimes clients like to ask me, what's your best idea, or what's some really interesting stock that you sort of can drive. We've got some really interesting ideas across a broad universe, and what we don't want to do is just sort of go all in on a singular stock. And what we ultimately want to do, Joel, is deliver a very boring return stream, just consistently delivering outperformance against the index from a wide variety of stocks, making sure we're not relying on a single stock or industry to drive that return.
It's a fascinating approach to investing, and the way technology allows us to do it now, it's quite amazing.
Yeah, I mean, it is, Joel, and often, we talk about a systematic process, we talk about data and technology, but I think the recognition that data and technology is part of our everyday life. If you've got a smartphone, there's an algorithm that sits behind it. If you get on a train in the morning, there is an algorithm behind this sort of how fast the train goes, the train timetable. You flick on Netflix, and there is an algorithm designed to sort of read what you've sort of watched in the past and what you might want to watch in the future. So data technology is sort of part of our everyday life. And really, ultimately, what we're doing is taking that same level of insight and engineering portfolios to deliver levels of outperformance into the future. So I don't want clients to sort of think of this as unfamiliar territory. It's not too dissimilar to what we're seeing in everyday parts of our lives.
Exactly.
I sort of mentioned the outperformance. This is since the fund started in 2021, sort of delivered 21% of absolute returns against the benchmark. We've delivered a sort of 7.5% outperformance range, which has been very, very pleasing, but all within a risk-controlled environment. Again, I sort of want to stress that sort of risk-controlled nature of our portfolios. We do not wake up at night wondering, pardon me, did Russia invade Poland? What are the effects on the portfolio? When the whole geopolitical issue started in the Middle East, because we're sort of neutral on sectors, we knew we had some overweights in oil and gas, we knew we had some underweights in oil and gas. Net, we were there. And that's sort of the level of comfort that sort of drives, that allows us to sleep well at night and deliver that consistent return stream. But I think what's really, really interesting is when you sort of think of Roger Federer, we like to sort of think that he sort of copied the Vinva way. He delivered a speech at Dartmouth University where he sort of mentioned that he's sort of won 80% of his matches, 54% of his points, I believe. Not too dissimilar to a Vinva portfolio. When you look at on the average day, we're delivering a 56% win rate on the average day. 56% win rate with about sort of 0.03% of outperformance against the index. Again, very boring, small amount of outperformance each and every day. And then we compound that daily with a 56% win rate. And that's what delivers that sort of level of return over the long term. And if you actually compare it on a monthly basis, that compares to about 64% of months we've outperformed the index. Annually, that translates to about 80% of years where we've outperformed the index. And that's sort of that compounding nature of we take lots of small little bets, lots of small little outperformance, and just compound that day to day and deliver that sort of steady return stream through your clients. And we don't typically sort of sit in the superhero bucket or the villain bucket. We're not going to sort of sit there as the best performing manager over 1 year in your portfolio. But when you compare us over 3 to 5 years, take a longer term horizon, you sort of start to sort of see the risk controlled compounding nature of the portfolio where Vinva starts to stack up with some of your more high octane managers. And that's really what we're about, is that consistent return stream for your clients, consistent alpha, and compounding through time. And maybe a really interesting chart to finish up on, Joel. Here we can sort of go through any of these sort of geopolitical challenges that we've had in market. Trump tariffs is a really interesting one. And you can sort of see on any given day, red is underperformance against the market, green is outperformance. This is his basis points. And you can sort of see Trump tariff day, our portfolio has delivered circa sort of 10 basis points, 0.1% outperformance against the index that day. Credit Suisse crisis, that was actually a really significant event. We actually delivered a 0.6% underperformance against the index. Again, that's pretty substantial for us, but relative to other managers where they're going to have huge swings, that's not what we're about. We just sort of sleep well at night, knowing that whatever happens next, we're well insulated. Again, I can go through any of these and sort of deliver. But again, it's about capturing that market return. So it's sort of mentioned earlier about delivering market return. that's that grey bar. We want to capture that. We don't want to miss out on that. And consistent, 3 basis points a day, it compounds up into a meaningful amount. And on a community basis, the portfolio since its inception has delivered 164%, whereas compare that against the benchmark, that's 91%. And that's what we're about, and that's what clients can expect from a Vinva portfolio over the long term. And that's really the Vinva genesis.
Yeah, so that systematic strategy and getting that little bit extra of daily alpha and compounding can really make a big difference over the long term, as we can see here.
Absolutely, absolutely. And look, Joel, consistency is our game, and we are an active manager. We have and will have into future periods of underperformance. Ultimately, for us, we look at things more broadly, and the sort of ultimately when we do underperform, it generally tends to be a lot shallower compared to the market. So if the market's delivered 5 and we've gone through a really rough period, we're probably delivering 4 under the benchmark because of the way we tightly constrain. And what we found historically is they often tend to be shorter periods. And that's where time diversification becomes your friend, where you sort of trust your process, understand that you continuously evolve as the market changes, continue to assess data, not being dogmatic about your approach, and taking a longer-term time horizon around consistency of outcomes for our clients. And really, that's us in a nutshell. And when we sort of think about what your clients are invested in, the Vinva Global Alpha Extension, got the benchmark there. It is a developed market only, so we don't have any emerging markets within the portfolio, and deploys that little bit of shorting.
Well, Paul, thanks for giving us an update on what's happening with Vinva and how the portfolio has performed. But before we leave you today, is there anything else you'd like to add?
I just want to thank you, Joel, and your clients for their ongoing support. One note I'd love to finish on with clients is we can never guarantee future performance. One thing I can assure you is that we sort of look at the business from the windscreen, and that we're working extraordinarily hard. There's no off-season in what we do, and we're only as good as tomorrow's performance. So we're working really, really hard to ensure that we're looking to deliver that consistent return stream for your clients into the future.
Thanks, Paul. I appreciate you making the time today.
A pleasure. Thanks again, Joel.
Paul, I appreciate you making the time to speak with us today and to provide an update of what's been happening with Vinva over the last 12 months. If you'd like to have a discussion about whether your portfolio is suitable for your investment needs and objectives, feel free to reach out to me via our website or give our office a call.